See, how much of the portfolio are we talking about?
Sina, what was your question?
Christina, what was your question?
How much of the portfolio amount?
So for each of these managers, is somewhere between 23 and 25 million for each manager.
All right, so we are live.
Which is Christina, which is about 3% each.
No, but are we looking to select a manager or multiple managers today?
We're looking at giving both of them.
Okay.
Yeah, so if you recall from the last meeting, we had a search that had multiple managers in it, and we sort of we made the recommendation to down select these two for, you know, assuming presentations go well today, to make an allocation to both. Because as you'll hear, they each kind of do different complementary things in the fixed income world.
Okay.
All right, so we are live.
So we do have a quorum. So
We do have a quorum.
Louis,
I'll go ahead and start.
Louis not here.
That's right. We have the co-chairs of the committee, both Christina and Albert are here.
Okay.
Yes. Good afternoon, everyone. I'd like to call the meeting to order for January 16th, 2025. Sue, can I get a roll call vote, please?
Angela Banks, Christina Bennett,
Present.
Louis Cross, Emily Hubbard, Shanice Johnson, Yvette Levy, Jennifer Orr,
Here. Present.
Bobby Richardson,
Present.
Albert Sanders,
Here, present.
Doris Walker,
Here.
Sadie Weiss. All right, so we do have 5, so we do have enough for.
Thank you, Sue. Next, I'd like to turn it over to Jeff and Guelda from Mariner to introduce our agenda today and take us through the selection of the fixed income portfolio.
Okay, we have 2 managers here today, both Loop Capital and Wellington. Wellington, we're looking at for a multi-sector fixed income allocation, and actually Loop is more like a core plus, and Jeff, correct me if I'm wrong. We have that today. We also have the recommendations with respect to allocation to private assets, the pacing study, which you'll see there's some areas that we don't need to add anything to. And to round it out, the last thing we have is the flash report for the month of December. I believe that's everything. And we were going to start out with the managers. They each were told they had 30 minutes each for presentation and Q&A. And the first group up, I believe, is Loop.
And they are not in the waiting room.
They're not in the waiting room.
No.
Jeff, can we go ahead with Wellington if they're there?
Yeah, Sue, I have a response from Adam. Adam says he's in the waiting room.
Okay, yeah, I just sent him this Zoom credentials again, so hopefully you try to use, because I do not see him in the video.
Are the people from Wellington there?
No, they were scheduled
Later.
yeah.
We told them
Yeah.
4:30, I think.
Yeah. So I just sent Adam the Zoom credentials again, hopefully, but I do not see them in the meeting. Okay, he's in there. Adam's there.
Hi, everyone.
Good
Hello.
evening.
Good evening. Sorry, I don't know if we may have been in the wrong Zoom room. Hope we didn't keep you waiting.
Thank you.
We were running a bit behind. Is anyone else joining you, Adam?
Yes, I know Jackson received Susan's email, so he's trying to sign in as well.
Okay.
Hey, Adam, it's Christina Bennett. Nice
Hi,
to see you.
Christina. Nice to
So
hear
as
your
soon
voice.
as you all are ready, Adam, so we've a lot of, we're a little behind, so don't worry about being done by 5 o'clock, but we've still allotted 30 minutes. So
Okay.
for to really focus on high level firm overview, talk a little bit about the team that manages this mandate, and then maybe a brief overview of the actual investment strategy.
Yep. Do we have a moment to wait for Jackson, or would you like me to? Oh, perfect. There he is. Hey, Jackson. Jeff was just Jeff, I don't want to steal your words. You can say it better than me.
No, yeah. Again, hi, Jackson. We're allotting 30 minutes today, so if you could use that 30 minutes to give us an overview of the firm, the team that manages this fixed income portfolio, and then just give us an overview as well of the strategy. That would be great.
Perfect.
And
Great. Hi, can everyone hear me?
trustees will jump in as necessary with questions. So
Okay. Jackson, we can see you and we can hear you.
Okay, great.
Would you like me to put up the presentation that you all sent, or?
Yes, please.
Okay. And then just tell me when you want me to advance it.
Okay, I guess you can start things off on slide 2. Great. All right. Sorry, I'm having some technical difficulties. Okay. All right. Well, first off, everyone, sorry that we are a little late. I guess there was some troubles with logging into the meeting, but my name is Jackson Smith. I'm a senior vice president at Loop Capital Asset Management. I'm joined by Adam Phillips, who is one of our managing directors. And first off, just want to kick things off by saying thank you. Thank you for having us this afternoon. The opportunity to present to you. It is greatly appreciated. We have about 20 minutes of commentary and have saved the last 10 minutes for Q&A. So with that, I'll go on ahead and get things started. Moving on to slide 3. This is an overview of Loop Capital. Founded in 1997, Loop is one of the nation's largest minority-owned financial services firms. We have nearly 300 professionals and over 20 offices across the country. And if you look at the map right above, you'll see that one of those offices is located right in St. Louis. Moving on to slide 4. Your consultants told us that you were interested in learning a little bit more on the background and composition of our firm. So we put this slide together. So as you will see on the charts below, Loop is an extremely diverse organization at every level, ownership, leadership, and across all of its business lines. Almost 80% of our firm is owned by people of color. And then on the last line of the bottom chart, you will see the breakdown of our team at LCAM, of which 67% of us come from diverse backgrounds, and 25% of the team is female. Moving on to slide 5. As one of the largest minority financial services firms, diversity is obviously extremely important at Loop. In 2024, Vault ranked Loop Capital #1 for best banking firms for diversity for a 4th consecutive year. Loop Capital is a founding member of the Financial Services Pipeline, whose mission is to increase representation for Latinos and African Americans in the financial services industry across the city of Chicago. Loop and its employees are also active members in a number of organizations. Just a couple of those are NASP, TIDE, and IDAC, to name a few. And then, externally, Loop Capital regularly selects qualified minority and women-owned businesses as vendors. And as it relates to our group, LCAM, we focus on working with minority brokers. Lastly, now in its 25th year, Loop has one of the most diverse summer internship programs, with nearly 75% of interns being people of color. Moving on to slide 6. This is the slide that I am, extremely proud of, because, I kind of consider this program, to be one of my babies. But in 2023, we started our own internship program in partnership with Texas Southern University. Sorry?
Oh, excuse me. That was an accident.
Okay. Sorry. So in 2023, we started our own internship program partnership with Texas Southern University. And as some of you may know, TSU is one of the nation's largest HBCUs located in Houston, Texas. And so each year I go to TSU and interview a handful of students and ultimately select 2 to participate in a rotational program that really just gives them, just a rundown in what it means to work in the asset management industry. So they participate in rotations with our investment team, with our operations and compliance teams, and then lastly, with our marketing and client service teams. And at the end of the program, the interns actually get to give a portfolio review meeting with one of our largest clients. Some of our interns have gone on to work for organizations like Goldman Sachs, Phillips 66, and S&P. And I think that if you were to ask them, they would all say that the LCAM internship program was a great experience. And actually, 2 of our current interns, Jemiah and Samaya, helped create this slide. So they are, they get to be a part of this presentation today as well. Moving on to slide 7. Now a little bit more about our group, LCAM. So we have successfully managed fixed income portfolios for 40 years, dating back to our inception in 1985 as Taplin, Canada, and Hayback. Today, we have grown to become one of the nation's largest minority-owned fixed income managers with right at $9.8 billion under management. As you'll see on the chart in the top right, approximately $4.3 billion of those dollars are located within our aggregate strategies, of which we are here to discuss today. We saw tremendous AUM growth in 2024. We actually started out the year at 8.5 billion and we're able to grow to 9.8 by the end of the year. And, fingers crossed, within the next couple of months, we'll be crossing that $10 billion threshold. At the bottom of this page, you'll see our key attributes and differentiators. And so Adam is going to cover the majority of the investment attributes during his portion of the presentation, But I wanted to take a second to focus on number 4 at the bottom of the page, commitment to partner with clients. So, you know, at LCAM, we pride ourselves on our client service. And so you will have direct access to senior personnel as well as key decision makers, you know, at all times. And, you know, personally, my phone is always open, always on, and I'm always ready to work with you as one of our clients. Moving on to slide 8. On this slide, you will see that we work with some of the largest and most sophisticated organizations in the country. Over 50% of our AUM comes from public clients. So we have a great amount of experience working with organizations just like yours. To name a few, at the top left, you'll see the St. Louis Treasurer. We also work with the Teachers Retirement System of the state of Illinois. And I realize it's not a public plan, but it is kind of cool. We do manage money on behalf of the Federal Reserve Employee Benefit System, and we have been doing so since 2017.
Jackson, right?
Yes,
Can I just make a small recommendation?
of course.
That first client should be the City of St. Louis Treasurer's Office.
Okay, we will change that. The City of St. Louis Treasurer's Office. Great, thank you. All right, moving on to slide 9. This page is a snapshot of our investment and leadership team. Just some quick stats. There are 17 members of the team. We have an average of 18 years of industry experience. We have 11 years of average company tenure. So it's a very seasoned team, and we have a lot of experience working together. There are 13 members with advanced degrees or CFA charter holders. And then last but certainly not least, 63% of our team comes from 63% of our professionals come from diverse backgrounds. And so, as I mentioned earlier, diversity is extremely important at Loop, and I believe that our team is a great example of that. And now I'm going to pass it on to Adam for the investment portion of the presentation.
Excellent. If you wouldn't mind, Susan, going to slide 11. Thank you so much, Jackson, and I'll just echo what Jackson said. Thank you all for the opportunity today. I understand from your consultants that you've already been pretty well prepped in terms of kind of who we are on the investment side, so I will keep my comments relatively brief, but certainly would welcome questions either during the discussion or at the end. So just to highlight kind of who we are philosophically, we do believe that fixed income markets are inefficient, and that creates persistent opportunities for those of us who do the work to dig in and find value in the market. Jackson talked about some of our differentiators before. As we think about it from the investment perspective, we think about a multi-dimensional alpha. So moving around with the markets to see where there's value. Sometimes that is in picking corporate bonds versus mortgage bonds. Sometimes it's picking higher quality or lower quality. And sometimes it's really picking that individual bond, the Coke versus Pepsi, and seeing which has more value for our clients. The other piece I would say that's important and a differentiator is our high conviction approach. So we just took over a portfolio. As Jackson mentioned, we've been fortunate to have quite a few wins this past year. We just took over a portfolio from another manager that had 1,500 line items in it. Our portfolios are going to be a lot more focused. The strategy and the fund that we're discussing here has about 245 line items, and that means each bond is there for a purpose. It's there to drive value. It's there to find a spot where there is a mispricing, and we can capture value for our clients. And then the other piece that I think is unique about our process is the strict relative value discipline. So really, whatever we're looking at, it's finding the mispricing. Again, whether that's talking about sectors, maturities, individual bonds, it's understanding that something somewhere is mispriced, and the job of our team is to go find it on your behalf. If you wouldn't mind going to the next page. So this is a brief snapshot of that investment process. It's a lot. The full deck has about 70 pages. We're trying to spare you that. I know, just in the interest of time, but so to kind of highlight, a few of the pieces here, we think about the world both from the global themes, so what's happening in the business cycle, what's happening with interest rates, what is the Fed doing, what are other central banks doing, what is the dollar doing versus other currencies, how is the corporate backdrop, what's the housing market look like, all these big topics, and then we distill them down into what we think that means for fixed income investors. At the same time, our analyst team is looking at individual companies, that Coke versus Pepsi example that I gave before, and really trying to figure out which individual bonds, which individual sectors are mispriced. And then we have regular communication, 2 meetings a day for the full investment team, 1 meeting once a week where we go through best ideas, really constant communication to find the best bonds for our portfolios. And again, it involves that full team that Jackson highlighted before. If I could direct you to the following page. This is a snapshot of one of the proprietary tools that we use. So this is something we created in-house. And the goal is really to just create a consistency of process. We look at 5 big categories of things going on in the world. Then underneath them, they have multiple subcategories. If we actually expanded this out, there's even more subcategories. But the point is really to build a system where we can track what's going on in the market, where we think there are opportunities, and what we think is different about our approach versus the market. And where we're different is where we're going to be able to find value. If you could move to the following page. This is the Core Plus strategy that we've been asked to talk about. There's a lot here. I'll talk about a few things really just to highlight. If you look at the bottom left, the yield to worst, so this is a conservative metric of how much income the portfolio is generating. And what you can see here is the portfolio is generating almost a full % more income per year than the benchmark. We think that's important. Ultimately, fixed income is about income. And so our goal is to build portfolios that have an income advantage versus their respective benchmark. And that's part of how we're going to lead to the outperformance for you. The other item I like to highlight on that bottom left chart is the effective duration. This is how sensitive the portfolio is to moves in interest rates. And you can see we've deliberately designed the portfolio to have the same level of interest rate sensitivity as the benchmark. That can be an area where you can really have a lot of deviation. But we also think it's very difficult to predict over time. So we really want to be focused on the areas where we have predictive power, we can add value, and that's going to be a lot more in the sectors and the securities than it is in interest rates. Couple of other items to highlight. If you look in the kind of middle chart on the right, you'll see that below BBB can also be called high yield. And that's not a particularly high number for a Core Plus strategy. This strategy can go up to 20% in high yield. Right now, we're showing a little bit below 7%. And what I think is important there is to say, just because we have the allowance to take some risk in this portfolio doesn't mean that we will. We're going to really go back to that relative value discipline. When we're getting paid on behalf of our clients to take that risk, we're going to do it. And when we're not, like today, you're going to see a lower allocation to things like high yield. So again, very judicious in how we allocate the capital. And again, very mindful of the risk in the portfolio. But again, aiming to deliver that outperformance that you and your beneficiaries are seeking. Next slide, please. All right, now down to the good stuff. So I know there's a lot on this page, but we really want it to be as transparent as possible with the performance that our strategy has generated historically. So you can see a variety of different trailing periods at the bottom, as well as gross and net performance. So that's before and after fee, how it's compared to the benchmark, as well as the outperformance. What I can tell you that I find most exciting in the ability to communicate this, that outperformance number is positive across all of those trailing periods. Importantly, the market has had some volatility. There have been some good times and some bad times. And when you look across the trailing periods as of the end of September, what you'll see is that the outperformance is true both in those positive periods, for example, the 1 year the 1 year and the 5 year, but also in negative periods like the 3 year. And so whether the market is doing poorly or doing well, our strategy has outperformed it. So that's very exciting and something we're very proud that we've delivered to our clients and their beneficiaries. Adam,
this is Gwelda. I'm one of the consultants on the relationship.
Yeah.
Do you happen to have, I know they're not in the presentation probably because of the timing. Do you happen to know where you guys are through December 31st?
Yes, good question. So you're absolutely right. We just finalized these numbers, so we're happy to either share them as a follow-up, but I can talk about them now. For the quarter for December, the portfolio was down 2.52%, which outperformed the benchmark, which was down negative 3.06. So almost 0.5% ahead, or actually a little bit more than 0.5% ahead. And for the year, the portfolio ended 2.97%. So that's all of 2024 versus the benchmark of 1.25. So just shy of 1.75% outperformance for the year.
Right. Thank you.
Yes, and I do have some reference here to peer group data that won't be available for a little bit longer. Not everyone gets their data into the databases quickly. Importantly, we think about performance over a 5-year rolling period, right? There can be a lot of noise short term, but we think it's important to look at kind of what we would call a market cycle. And so if you look at 5-year rolling periods, this strategy has outperformed the benchmark 100% of those times. Doesn't mean it always will, but it's certainly a good indicator of what has happened to date. And then as we compare versus peers, so other managers in the same strategy, and again, we look at those 5-year rolling periods, we've outperformed the peer group 70% of the time. So again, feel very confident in the strategy, both against the market, but also against competitors. And so those are things that, all of the things we've talked about so far, in terms of the strategy, the approach, the strength of the team, the strength of the company, all of that contributes to this. We could go to the following slide. So we have included a preferred fee schedule based on the relationship with Mariner. Your consultant and their research team put us through the works, did quite a bit of work on us, made us do quite a bit of work, but we're very proud to partner with Mariner, be an approved manager, and we do have a preferred fee schedule available for Mariner clients. We think it's quite compelling, so did want to include that here as well. And then if I could summarize on the last page, 17, just a few bullets, why LCAM, bringing together Jackson's comments and my own. There's a lot here, but just to give a few items. Again, we believe the strength of Loop Capital and that platform and our commitment to partner with clients is a real advantage. As Jackson mentioned, Loop is one of the largest diverse-owned financial services firm. And so to that idea of thinking a bit differently than the market, we think that's important. I mentioned the preferred fee schedule. Jackson mentioned the direct access to senior leaders and key decision makers. The diverse and inclusive team, again, looking at everyone's backgrounds, experiences, bring that together to bring a different perspective to markets and help with that outperformance. 30 plus years of partnering with public plans, and public plans making up over 50% of our asset base. Clearly, this is an area of focus for us, and it's a strategic priority for us as we continue to grow the business. And then our success in managing the strategy. So we've outperformed on an annualized basis. So, kind of each year on average, about 139 basis points or 1.39%. Gwelda, to your question, including December, that would jump just over 1.4%. So we'll always take numbers that improve the outperformance. And that does rank us in the top third of the peer group since inception. So again, numbers and performance that we're very excited about. I did mention the outperformance and consistency versus peers over 70% of the time on those 5-year rolling periods since inception. And again, outperform the benchmark 100% of those trailing 5-year rolling periods. So those are the comments we had prepared. Again, very much appreciative of your time for the opportunity to present today. And we would sincerely appreciate the opportunity to work together. And we'd be happy to answer any questions.
Any questions from anyone?
Guess not.
Okay. Well, maybe we'll, catch up a little bit on that schedule, I guess.
Oh yeah, you've given us back some time. Thank you. Appreciate it.
Happy to do it. And certainly if there's any questions after the meeting, we're also very happy to respond to those as well.
Yes.
Thank you, Adam.
Thank you for your
Excellent.
time.
Thank you so much.
Great.
Really
Thank
appreciate
you.
the opportunity.
Thank you both for joining this evening.
Thanks for presenting to us. It was a good presentation.
Great. Thank you. Thank you for the feedback. Have a great day.
You too. Take care. Was there any discussion or questions for Jeff and I? Okay.
It sounds like crickets, don't it?
Yes. Sue, are the other presenters in the waiting room?
Yeah, I have Rachel and then I guess 2 other people, Kyra and Greg Williams. I guess those are both Wellington folks.
Okay. Yeah, so maybe we'll have them in, and then that way everybody can sort of have the context and the differentiators between the two, and then we can talk a little bit after Wellington and come up with a game plan.
All right, so I'll let them in.
Okay, hello everyone.
Good evening.
Good evening.
Good evening.
Good evening.
Hello.
Greg, is this everybody on your end?
I'm looking through the screen just to make sure that we're all on. I see Rachel, Kara.
Rachel and Kyra.
Anand. Yeah, Anand, are you on by chance?
Anand's not on. I think he was might be in the old Zoom and is getting in right now.
Okay, oh yeah, there we go. So
Sorry
yes, we
about
got
that.
one more person joining. We give him 1 sec and then we can get things kicked off.
Yes.
Seeing. All right. Anand, are you aboard?
Yes, I am. Can everybody hear me?
Yes.
Can, yeah. Okay, so you've got the full Wellington contingent on the line.
Sue, I believe we have a presentation. If if you want us to pull that up, and you can direct Sue to the pages you want to speak of. But I'm Jeff Cookta with Mariner, and Gwilda Swilly is also for Mariner. And then the rest of the group here is the investment committee from the public school retirement system of the city of St. Louis. And we'll give you all 30 minutes today to provide an overview of the firm and the team, and talk briefly about the investment process. And then if anybody has questions, they'll jump in along the way. So take it away.
Great. Well, thanks so much to everyone for joining us. We're excited to be here this evening and appreciate your interest in Wellington and in multi-sector credit. So quick introductions. I'm Greg Williams, do business development management for Wellington based in our Chicago office. I will say I am not a Cubs fan, just so all of you guys know that, given we're talking to a St. Louis audience. So I'm joined by Rachel Dickey, who is an associate business developer that works with me in Chicago and be part of our relationship. Also Kira Fektow, who's one of the portfolio managers on multi-sector credit, and Anand Duran, who is the investment director for the strategy. And Anand, you can view him as very much an extension of the portfolio management team, knows the strategy at a granular level, but also has some business management and risk oversight responsibilities as well. And so first and foremost, again, thanks for the opportunity to speak with you about multi-sector credit. I'd start off by saying, we know how important it is to prudently manage assets on behalf of your participants. It's a responsibility that we don't take lightly. And hopefully throughout this presentation, you'll get a better understanding of why Wellington is a great fit for you going forward. If we can, Susan, please go to slide 4, and I'll start briefly on the firm. And we obviously want to spend most of the time just getting you up to speed on what's going on in the portfolio. But I start here on slide 4. And really, to me, these are the key underpinnings of Wellington Management Company. First would be our ownership model. We're a private partnership. When you think of the large firms out there, we're one of the only few private partnerships that still exist. I'd point to the 4 boxes in the middle and start with our ownership model. So we, again, are the private partnership, and we think that's important to our clients for a couple of key reasons. But most importantly, we'd say it's allowed us to attract and retain key investment talent over long periods of time. I think Kira is a great example of that. Anand's a great example of that. And the rest of this team is a great example of that. It's a team that's worked together for many years. And, we think that the ownership model, and again, the ability to keep people at our firm, leads to a consistency of philosophy and process and portfolio construction that our clients value. We won't get every investment decision correct, but at least what lane we're skating in at any given point in time. And that consistency, I think, will allow you the comfort of knowing what to expect from us. The second area would be our business model. And it's super simple at Wellington, and we like it that way. We solely focus on investing assets on behalf of our clients. Folks like Kira come in every day thinking about how they're going to generate alpha on a daily basis. Rachel and I come in thinking about how are we going to take really good care of our clients. We know if either of those two, things falter, our overall business is at risk. So you can rest assured we're myopically focused on those outcomes on a daily basis. And then the last thing I touch on this slide is our investment model and our culture. And I really do think these things go hand in hand. And in particular, I think multi-sector credit is a great example of the power of our investment model and our culture coming together. So I'd say, at our firm, when you want to become an investor, there are a couple of routes you can take. You can be like Kira and say, hey, I want to come to Wellington and look across different sectors, within fixed income. You can also come to Wellington and be a specialist and say, I really just want to focus on things like high yield or bank loans. And actually, Susan, I'll have you flip to slide 5, and maybe this visual depiction will help out with demonstrating this. You can come to our firm, be a specialist in these different areas, emerging market debt, which again is part of our portfolio here. I'd point you on this slide, and this is the list of all the investment resources at our firm. So, 900 plus investment professionals doing different things within the firm. In the first section, it's our product research team. And on the top line, it's our credit analysts, right? And so at our firm, you can come here and say, I want to be a rock star credit analyst that focuses on healthcare for the entirety of my career and just specialize in that space. That can very much be a path to partner at our firm, and whereas at other firms, sometimes it's more of a rotational program. And so ultimately, a lot of numbers on the page, a lot of different areas that we're focused on this page. But I think the true secret sauce is whether you be a fixed income portfolio manager, a credit researcher, an equity analyst, a macro researcher, everybody on this page is collaborating. Everybody is delivering information into the Wellington ecosystem. We have a really rich cross-pollination of ideas in a portfolio like multi-sector credit, where we are looking across sectors. That cross-pollination and idea flow helps to inform Kira and the other portfolio managers on the decisions they're making in their overall strategy. At the end of the day, the buck does stop with them, but we think, again, this robust ecosystem allows us to hopefully make a more informed investment decision on behalf of our clients. And with that, I'll flip to one page forward to slide 6. And I do want to touch on something that I know is important to you, very important to us, important to me personally. It is our diversity, equity, and inclusion approach. And I'd say at our firm, you know, for years, we've had a real comprehensive and action-oriented approach to how we go about building a diverse and inclusive organization. It starts with, you know, a number of individuals, including Shauna Ferguson, our Chief Diversity Officer. We've got a Diversity, Equity, and Inclusion Committee. I'm a member of that committee and have been for years. We've got a system of 15 different business networks at our firm as well. So structurally, we've got the infrastructure in place to support what we think it can really be a diverse and has become an even more diverse organization over time. On this slide, you'll see the key pillars of our diversity, equity, and inclusion strategy. So for instance, the talent bucket, we think you've got to be proactive and go find the diverse talent, train people, and allow them to flourish. And so wrapped within that, we've got things like an HBCU scholars program. We're bringing students in every summer, you know, from historically Black colleges and universities, giving them financial support, giving them professional development support, and again, allowing them to get exposure to our business, to our company, with the goal, hopefully, over a few summers of them becoming full-time employees. I'll skip culture for a second, would move to community and say that we're also very much engaged and involved in the community, whether that be with the Wellington Management Foundation and our support of diverse focused organizations. We're also very much involved in organizations that many of you are involved in, like NASP or MLT, Girls Who Invest, 100 Women in Finance. We financially back those organizations. Importantly, we also don't only cut a check, but we participate in helping with programming for those organizations. So for us, being involved in the community is very important. In addition, you know, what we do best at our firm is invest. And so we've got an investment pillar as well. And I'd highlight one key thing that's happened more recently over the past few years is, you know, we say, all right, if we're really focused on investing, we think that that's our secret sauce at our firm. How do we utilize that edge in order to enhance diversity? And one thing we've done more recently is launch Wellington Access Ventures. And so that's a private equity early stage fund that's focused on investing capital in founders and fund managers from diverse backgrounds. We launched that about 3 years ago. And ultimately, again, to us, that's a way for us to put our participants' money where our mouths are, right? Like if we're saying that we want to enhance diversity in the industry, this allows us to really put dollars behind our conviction. And then lastly, I would go back to culture and just say, for me, as a person of color, I've been in and around Wellington since 2006. And I think this is really what makes us an attractive organization for people from diverse backgrounds. We're an inclusive place. We seek people from different backgrounds. We are open-minded to everybody contributing their voice at our firm. And in fact, that's part of the demands of working at Wellington is, again, contributing to the dialogue at our firm. And we think ultimately the culture that we've created ends up being a place that attracts and retains diverse talent from multiple backgrounds. And I'm an example of that, where I was a huge career changer getting into this business. Wellington gave me the opportunity to flourish, ended up getting on the path to becoming a partner at our firm. And there are others that are just like me. And, you know, for us, it's not just words on a resume. It's who we think people are. If they have the attitude and the aptitude to excel in our organization and in this business, we want to give them a shot. We're very focused on providing those opportunities. And so I will stop there and see if there are any questions at all. Okay, hearing none, we will now shift gears and jump into the world of multi-sector credit investing. And so with that, Anand, I'll turn it over to you to jump in.
Great. Well, thank you very much, Greg. And thanks again to all of you for inviting us here today. We're really excited to share a bit more about what we do in this multi-sector credit space. And I'm going to start off with a few comments just on what we define as multi-sector credit, why we see value in it, and the team that manages it. And then I'm going to hand it off to Kira to share more detail on her background and how she is part of the investment process for really bringing together insights from all over the firm to build our multi-sector credit strategy. Staying on page 8 for a minute, just because this is quite a heterogeneous universe, I wanted to spend a moment sharing how we think about multi-sector credit. This is a strategy that we've been managing since 2012. It's been managed that whole time by the same lead portfolio management team that built the strategy, and I'll talk more about them in a minute. We now have about $7.5 billion under management in the strategy with a global client base, including significant work that we do with other pensions in the Americas throughout the US as well. The way we define multi-sector credit, we really think about this as a diversified allocation to public higher yielding fixed income. So we will invest opportunistically, say, in US Treasuries or investment grade credit, but by and large, we're going to be focused on finding the best ideas, the highest conviction ideas we can to implement our views on the credit cycle through US and European high yield loans, convertible, or these are publicly traded 144A loans, convertible bonds, securitized credit, and emerging market sovereign and corporate debt. So we're not buying equities at all. We're not buying pure privates in this approach. But within this universe, we still think that there is this real breadth of credit market dislocations. And by bringing the best insights from all over the firm, we're confident that in any given environment, we can find these credit market dislocations to create an attractive and highly diversified yield profile. As we've been managing this approach over time, we've noticed that investors in the approach are often coming to it to look to consolidate their management across higher yielding fixed income sectors. So rather than just have an allocation to emerging markets or just have an allocation to high yield, this is seen as a way of getting exposure to that broader universe, but through with more diversification without putting all your eggs in one basket. This is often used as a complement to core fixed income because our investment universe has very little overlap with the investment universe of a core bond strategy. And more recently, we've also seen it often as a diversifier or replacement to equities because, these higher yielding markets returned close to double digits last year. We're finding a lot of places where we still think that valuations are attractive, and it could be one way of getting equity-like returns in some environments with more downside protection, and another way of just getting more out of one's overall allocation to fixed income. If we turn to page 11, I'm just going to share a couple of other thoughts excuse me, on how we put this approach together. And, I described a little bit about what we consider to be multi-sector credit. This is certainly a space where we've seen more interest and more flows over time. But it is really important to us, and something we feel strongly about is that beyond just the what is this space, so much of the value from allocating to a diversified multi-sector credit strategy really comes down to the how. How does a given manager actually utilize this broad investment universe to do something that's better or more attractive than a particular higher yielding sector? And there are three things in particular that I think are important to how we approach this multi-sector credit space. The first is really around the investment universe that we utilize. As best as we understand, we're one of very few managers that design a multi-sector credit strategy that's really focused on higher yielding fixed income sectors. And within that makes full use of high yield bank loans, securitized credit, and emerging market sovereigns and corporates. Over time, from where we've been allocated, you'll see we really are equal opportunity users of all of those sectors. And the way that we're able to do that effectively is through an investment process that really is built around that breadth of collaboration that Greg shared. I'll share more about this in a minute, but we're blessed to be at a firm with $1.3 trillion under management and a number of different investment teams who all actually talk to one another. It's by putting ourselves in that cross current of all that investment dialogue that we're finding more opportunities as they arise. And we think that what brings that together is a lead portfolio management team that has spent all of their careers as career sector rotation specialists. They didn't grow up in an individual sector. They grew up building multi-sector portfolios, which we think helps us to also reduce sector biases in the strategy. In the interest of time, I'm going to skip over to page 16 to share a couple of thoughts on the investment team And then I'm going to hand it over to Kira to talk more about how decision making works and how all these resources come together. So there's a lot of names on this page. I'm not going to go through all of them, but did want to share a couple of things. First, Kat Goodman and Rob Byrne are really the leaders of this strategy. They've been managing the approach together since its inception in 2012. And as I mentioned, both of them have spent their entire investment careers at Wellington, almost entirely focused on multi-sector strategies. Rob for 18 years, Kat for 25 years. Both are partners of the firm, which means we fully expect that they will spend the remainder of their investment careers with us at Wellington also. You're about to hear from Kira, who has been with us for about 4 years and is a securitized specialist, but whose research, for example, on the US consumer, on macroeconomics, informs all aspects of the investment process. And she's going to talk about that more in a minute. We could not do what we are doing in the strategy without all of the other folks that you see in the middle of the page. I'm not going to go through all of these names, but one thing I did want to share is that, again, so much of what we do here is effective because we have all of these other investment teams who, of their own volition, are coming to our meetings, are voluntarily coming to us with ideas about what to buy and what not to buy, who see it as beneficial to their investment processes to participate in our meetings, and who importantly are informing not just the bottom-up security selection, but also the top-down. About 2/3 of our value add over time has come from those top-down decisions around how much credit risk to take. And all of these other investment teams at Wellington working with us has been a huge part of how we're positioned around those top-down decisions. Before turning it over to Kira, I just wanted to pause to see if there are any questions so far before we get a bit deeper into the investment process. Great. If not, then I'll turn it over to Kira. Kira, maybe if you can start on page 17.
Yeah, great. Hi, everybody. Thanks for having me. Like Anand said, my name's Kira Fecto. I've been here now for just about 4 years. And prior to that, I was at Loomis Sales. I've spent my entire career investing in securitized assets as part of broader fixed income mandates. And I think that's important because, I bring a perspective to this process that I think Cam and Rob appreciate. In terms of like what can Securitize do for you, but not just that, but how do we make sense of all of these sectors and build a portfolio that works for our clients. So as we get into the investment process, like Anand said, we think 2/3 of our alpha comes from two of our biggest calls, the calls on the cycle and the calls on sector rotation. Both of these calls are heavily rooted in the Wellington edge, which you've heard from Greg and Anand at this point. It's not just the depth and breadth of the research at our firm, but also the collaboration that occurs. So our team can access the best and brightest resources we have in global research. So maybe turn to page 18 because we can talk about
So Kira, I might jump in. You're breaking up a bit, so I don't know if you want to.
I'm sorry. Can you guys hear it?
Yeah, it was kind of going in and out a little bit, but maybe now.
Yeah, you're better now, Kira.
Sorry about that.
No, yeah, we're good.
4 years into the pandemic, and I still have trouble with my my virtual presence, I guess. Let me know if you can't hear me again.
Yeah, it's doing it again. Maybe Kira, if you want to change your audio source, I don't know, Anand, if you want to jump in.
Okay.
Yeah, I'm happy to jump in while you figure that out. I can keep going, or if you just want to take off your headphones altogether, Kira.
Yeah, that might be the.
Go ahead. I will figure this out.
Okay, so I can pick it up right there on page 18. So I think what Kira was sharing an example of, as she had shared before, really our process, the two most consequential decisions that we're making are around how much overall cycle risk we want to take and where we want to take that cycle risk. And one thing that we're showing on page 18 is really that we are willing to make meaningful shifts to the overall risk profile as market conditions dictate. One thing that helps us here is that we're looking every month consistently at a set of valuation indicators that for us are helping to try and take some of the emotion out of the month-to-month decision-making and at least help us to make sure that we're seeing the same metrics around where could credit markets be attractive, which credit markets are attractive relative to other markets, to help us make these decisions. But a lot of the magic comes from not just what valuation quantitative indicators we're looking at, but how we're working with the rest of the firm to get the context for how to interpret those indicators. So to give one example that I think Kira was going to go into, in late 2019, we had no idea that a pandemic was coming, but we were seeing that credit markets were just looking tight. The economy looked fine, but we were seeing rising corporate leverage that was a little bit worrisome to us. We were seeing spreads near all-time tights. We were seeing a little, frothier M&A activity. But importantly, we were working with all of these other investment professionals around the firm on other teams to get their take on, are we just seeing this thing and reacting to it irrationally, or are you seeing something similar? And what we got from all that feedback in aggregate was actually a lot of credit investors around the firm weren't finding a lot of opportunities. And they said, we're not seeing a recession, but we're just not getting paid to take risk. And in particular, a few different investors even told us, if you're going to sell something, sell our sectors to reduce risk. So this was a case where by looking at a set of indicators that were paying attention to how they change every month, we were able to make a decision before things got bad to say, now is the time for us to be sitting on more dry powder and wait for a better entry point. We may have been early, but it was a decision we were able to make. Now, fast forward to early 2020, those same indicators started looking more attractive than ever. High yield spreads near all-time wides, default rates implying, or spreads implying a default cycle similar to the Great Depression. And in that kind of market, we had the ability to deploy that the liquidity that we had built up very quickly. You can see the dark blue line to make a meaningful allocation to high yield, which we then replaced over the span of a few months, working with our traders, working with other teams with some allocations to things like convertible bonds and securitized credit. I think Kira is back here. So
Can you guys hear me
Kira,
okay?
yes, I'm happy. Yeah, go ahead, Kira. I was just
Awesome.
sharing a bit more about how we make cycle calls.
Yeah, no, I heard it. It's great. You don't even need me here, Anand. This is great teamwork.
Kira, please take it away.
All right, so Anand covered the cycle call. So why don't we dig into sector rotation on page 19? And 19 is really a stylized example of our quantitative framework, which is the starting point for sector allocation. And this process is led by one of the lead portfolio managers, Rob Byrne. His process uses a great deal of historical data to determine future excess return potential of fixed income asset classes and expected future volatility. And so the sectors, what this is supposed to show you is the sectors at the top left quadrant should offer better risk-adjusted returns than sectors in the bottom right quadrant. And we're disciplined in this process and looking at it at least monthly to understand the changes in the investable universe. And while this forms a solid baseline, it's not the final verdict. Just like we mentioned before, in collaboration and talking about collaboration and working with our colleagues, the credit cycle decision or the quantitative sector rotation framework is really enhanced through that constant dialogue of an expansive network of sector specialists. And it's this interaction between specialists and generalists that I think is so important and really what I consider our secret sauce. Because these markets are complex. It's not enough to just say fundamentals are good or valuations are attractive, so let's invest. Sector experts are the ones that are intimately familiar with the technical backdrop, the ones that understand the liquidity profile of their sectors, the structural nuances of each of the subsectors, and CUSIPs in their space. So they're really invaluable partners to us in framing sector selection, in addition to doing the actual security selection. And I think this is best illustrated on page 20. Page 20 is an example of interaction that we as portfolio managers on the team have with our colleagues across the firm in credit research and equity research and trading. And I think the equity research is unique here to us because I think when you look across our competitive landscape, you will find fixed income firms that have access to other fixed income members on their team. They might have access to other fixed income members across the firm. But here at Wellington, I think a differentiator for us is our massive equity presence, and that equity presence that overlaps with our research that we're doing on the fixed income side. In this particular example, we're going to talk about housing and as it informs the discussion. And so here we're showing a stylized example of credit risk transfers, which are securities that are issued by Fannie Mae and Freddie Mac. where the underlying collateral is a reference pool of mortgage loans. So the way it works in practice, in real life, is Rob came to me one day and suggested, let's reduce our exposure because the sector looks quite rich in his framework. But upon further digging, I was able to show him how his quantitative framework wasn't sufficiently reflecting how the sector had really improved in quality. And as such, historical comparisons that we were using weren't actually comparable. And so on a risk-adjusted basis, when we accounted for how much the structures had delevered from the consumer paying their mortgages on time, and the embedded home price appreciation that had also helped to delever the structures, and after collaborating with these colleagues on the side of the page, credit research, equities, and trading, we determined that actually the sector presents a great value, and we maintained our allocation. And I think it's this example that really illustrates my role on the team with Camp and Rob as a true partnership. As an expert in securitized assets, I spend a lot of time thinking about my sector and its attractiveness in my narrow universe. But as a generalist, Rob and Camp have the 30,000-foot view, so they can push back on me when I'm reluctant to add risk. Or, if I say, my sector might be rich to me, but it's the cheapest thing they're seeing across their opportunity set, they can push me on that. And we work to overcome each other's biases. And this is probably best illustrated on page 23. When we have conviction, we aren't afraid to make meaningful sector allocations. And so when we see opportunities, we go after them. I'll highlight the increase in allocation in high yield on the top left in starting in August of 2023, and the increase in our securitized credit exposure in in early 2022, where we took the portfolio from about 7% all the way up to 17 to 19% because we had conviction in those ideas. So with that, maybe if I'll pause here for any questions, or we can take it in any direction that you'd like.
Hi, Carrie. Just in interest of time, I think there's a lot of moving pieces certainly on your strategy. So, I think what would be helpful for this group is just, and again, probably the biggest challenge question I could throw to anybody is, but for a strategy like this, where you say we can do a lot of things, do go here, go there, you compare and contrast that to, something that this group knows very well is just a core manager in the space. So how is it different? How does this add value? How does this complement something like that?
Sure. Anand, do you want to take this one?
Yeah, happy to. So Jeff, just to make sure that the question is around, how would we compare something like this to, say, core bond?
Right.
Yeah, definitely. So I think, maybe the point of similarity is that I consider both to be diversified fixed income allocations, and certainly some of the value add is going to come from diversification. If I maybe think about just the kinds of things that fixed income can do for you in an investment portfolio, the goal of a core bond strategy, at least as we manage core bond, is really around diversification from equities and liquidity. And certainly you're looking to earn some modest return on income, but really the goal more than anything is this needs to be the anchor to windward, particularly in those environments when you have an equity market sell-off, where you're going to have bonds that are going to behave themselves, and where you're going to have the effect of duration, hopefully leading to some actual positive market value appreciation if rates are also rallying in that environment. So that's a kind of approach, at least as we manage core, that's going to be primarily focused on US Treasuries, agency mortgages, investment grade credit, and very high quality securitized credit for the most part. Now, in this approach, maybe the commonality is that we're still rotating across different fixed income sectors, but the universe that we're drawing from is almost, I characterize as all the stuff that we aren't buying in core bond for the most part. And so we're finding a lot of what we think of as underappreciated opportunities in high yield markets, for example, in emerging market sovereigns and corporates that we don't think are going to be appropriate for a core portfolio. But if you're instead looking for something that could generate 7-8% yield, have a meaningful income profile as well, and maybe be a bit of an equity replacement, especially when equity markets are relatively rich, this is the kind of thing that can do that. Our team is actually, Kira sits right across the row from the leader of our core bond team, we're using a lot of the same research on where we think the market is, the credit cycle is headed, what we think are attractive and not so attractive areas, but what we're going to then use to implement our credit views here versus in core bond is going to be very different. And that's one reason that we would think of this as a strong complement to core. Yeah, go ahead, Kira.
Yeah, and I would just add, like, I mean, as you're aware, core plus products are benchmark relative products, which in some ways boxes you into a very specific investment universe. And I would categorize the multi-sector credit strategy and the process as being more flexible in the areas that we can invest, because we can take big out of benchmark sector bets, because our focus is more on, or is squarely on, achieving, really the best total returns in the sectors that offer those returns, with a less of an eye to being boxed in by a benchmark.
Great. So, and with the mention of benchmarking, it's a good segue to talk about your benchmark. If you have a performance summary page, if you can sort of summarize performance for us, and then we can kind of wrap up.
Sure.
Yeah, absolutely. So let's go to page,
27 on them.
27. Yeah. Actually, could we go one, or I think there are a few, sorry, my screen is freezing. If we could just go a few pages forward.
Maybe 35.
Yeah, let's go to 35. That's it. So performance-wise, maybe to set the expectation, we do not manage the strategy versus a benchmark. Over time, I would say a 5 to 9% total return over the course of a market cycle is what we're aiming for. I realize that is a wide band, but I'd also say that more recently we've been towards the upper end of that band as rates and all-in yields have been resetting higher. We are also paying attention, just for the sake of long-term performance measurement, to how this is doing relative to an equally weighted blend of high yield, bank loan, and emerging market indices, as kind of a naive proxy for static diversification. We'd be looking to outperform that index by 100 to 200 basis points over a cycle. So as you can see, over time, we have been achieving that kind of return profile. 2022 was certainly one year where we had negative total returns that was largely driven by the large reset upwards in rates over the course of 2022. About 60% of our total returns was driven by the duration in the strategy, which was lower during that year, but was still positive. More recently, in the last couple of years, you can see both in 2023 and 24, as well as prior to 2022, a number of years in which we achieved returns close to 10%. And importantly, the drivers of those returns from year to year were also quite different. If we actually go to page 26, apologies for jumping around, but this might help. What you'll see on page 26 is that which sectors contributed to returns have also been quite different from year to year. So for example, in more recent years, such as the past year, areas like emerging market corporates, certain areas of higher yielding securitized credit were very meaningful contributors to performance. In earlier years, it might have been high yield bank loans, perhaps convertible bonds. It also means that in a year like 2022, there wasn't one individual trade that impacted performance. It was also, still quite diversified. It just happened to be a year where rates went up a lot, but we were also still diversified, and that diversification did help us to at least somewhat protect the downside that year.
I just add too, while 2022 looks like a large drawdown, keep in mind that high yield and EM corporates were down 11 and 14% respectively that year. So, the strategy did as intended, and that we made the right sector calls and the right rotation. We had a better than market credit allocation.
Right, and our not having put all of our eggs in one basket helped to reduce the size of the negative total return.
So with that understood, I mean, tell us how a group like us, we still have to monitor the strategy, give it a reasonable benchmark and things like what, I mean, what would your typical investor benchmark this against?
Yeah, typical investor benchmark would be that equally weighted blend of global high yield bank loan and emerging market indices. Or we use an emerging market sovereign index just to keep it simple. And a number of our clients do ask for reporting of performance alongside that benchmark, and we're more than happy to share that in our client reporting.
Okay. Great.
Great. Well, we know we're probably a little bit over time, but maybe pause for any last minute questions at all or any other topics you might want to cover.
Greg, are the fees outlined in the
Yeah, Anand, do you want to cover fees?
Sure. So our standard management fee is 45 basis points. And that's the fee for our the multi-sector credit fund, the CIF2 multi-sector credit fund, which we've been managing since 2017. It has about $900 million in the fund.
Okay. Thank you.
You're welcome. Okay, any
Is the question is that the Mariner fee discount, or is that your standard, or is that what you're proposing for us?
It's a standard, Christina.
Okay.
I don't remember seeing a preferred fee for that. I can double check the search report, but I don't think they have a Mariner fee.
Exactly. I don't think we have a preferred.
That's right. I believe the fee that we
place.
had proposed for this was the 45 basis point
45
fee. I'm
basis.
happy to discuss fees, but that is the standard fee for the strategy.
All right, sounds good. Thank you. Are there any questions from the committee?
I have no questions, Gwilda. Thank you. It was a great presentation.
Great. Well, thanks again to all of you for taking the time this evening. We appreciate the opportunity to share our story with you. We'd love to go to work for you. I think we could have a really productive long-term partnership. And if you do have any follow-up questions post the meeting, definitely reach out. But yeah, we hope to speak with you again sometime soon. Thanks again for everything.
Thank you, everybody.
Great.
Thank you.
Thank you. for
Thank you,
joining.
everyone.
Good night.
Any discussion from the trustees versus the committee members? And on fees, I pulled the fee page. What we were talking about with respect to the Loop Capital, they proposed 25 bips, which was a preferred fee. And for your two core managers, and this would be a core plus mandate, which is a little bit more engaged than what you have in your core. Earnest is 25 and Manulife is 27. Manulife would probably go up to 30 because we're proposing taking some dollars from there. And actually for the Wellington portfolio, the manager we're looking at pulling dollars from is Lazard, who's 75 bips. So that's significant.
Significant savings.
Yeah. Jeff, do you want to wrap
Yeah,
up?
and so and just to sort of reiterate on that too. So not all managers will do what Loop has done, and that's great that they've done that. But both structures are commingled funds, not separate accounts. So separate accounts, it's generally it's easier to negotiate fees. Commingled funds, sometimes they run into most favored nation clauses and things where they can't give you better fees. Now, how Loop is doing it, they'll have a separate share class, and they can sort of get around that. I mean, we can talk to Wellington about that and to see whatever extent there might be some flexibility. But again, for that type of strategy, that still is it's a reasonable fee relative to what other multi-sectors do. And it has backing up also just from a little historical perspective and where we are with these managers today. So Manulife sort of got the temporary benefit of Exponence and Exponence having to wind down quickly, and we wanted to find a place that we could sort of temporarily park the money. But I think the intention always was, let's continue to find ways that we can diversify out the portfolio. And so that's kind of one piece of what's going on here. The second piece being we have a manager that's very focused in a very focused segment, emerging market debt. And again, if you look at a manager like Wellington who just came in and said, well, sure, that's a piece of what we do, but we're doing all of these different things. So you get that additional diversification, managers doing different things rather than just being specific to one area of the market, that when that's out of favor, you just don't know how badly it can be out of favor and how long that will last. So that's sort of our decision point as to if we're going to have this opportunistic bucket, do we want to have single siloed pieces like an emerging market manager, or something that can be a little bit more flexible and opportunistic and do emerging markets, but also do high yield and do treasuries or other securities and mortgages and things when they look good and they're attractive and should be in the portfolio. So they kind of fit two different roles. If you think about a spectrum between like a Manulife and Earnest, they're going to be very much like the benchmark, a lot tighter and a lot more risk aware. Loop's going to be pretty close to that, but add in that they have a little bit of flexibility, so they can be the benchmark, but do some things like high yield bonds that they talked about and other areas, but much more constrained on it. They're not going to get too crazy. They are looking at that benchmark, and then go down the spectrum a little bit more to things that might give you higher return, but are going to do it with more risk. And that's something like Wellington and things we put in the opportunistic bucket, the Loomises and the Newburgers that fall into that camp. So again, I think they each have different roles. I don't know if we were kind of looking at this as an either or. I think we at the last meeting showed a handful of managers and said these are both managers that we feel that could work in the structure, assuming everybody kind of liked what they heard today. So.
Jeff, I do have to say that I like the complementary strategies, right? They're not complementary in that one's qualitative and one's quantitative. They have actually different buckets that they play in, different lanes that they play in order to get that alpha. So I really like the complementary nature of both of these managers.
Okay,
So,
my question I'm sorry.
No.
My question is, right now, are we investing money in Loop and Wellington as of today? Are we having money with them now?
We don't have money with them now. We are proposing that you invest with the two managers, taking a slice out of Manulife, where we had put the Exponence fixed income money, taking a slice out of there for Core Plus, and then replace for Loop, and take the Lazard EMD rather than having a dedicated EMD manager, have the Wellington portfolio basically take over that portfolio and have it as a multi-sector, so they can opportunistically go where they need to go rather than having a dedicated EMD allocation.
Yeah, and Golden, I'm just going to say EMD again is emerging market debt.
Emerging markets debt, I'm sorry.
Okay.
So no, we're not investing with them yet. We are proposing these things today.
Okay, so tonight we had to make a decision. Do we want to invest with 23 to 25 million to either one of these organizations?
Well, to both.
To both. So
we
does
both
Sue have
making a recommendation? Which one
we have to make a recommendation and take it to the full board.
Okay.
So Sue, I'm assuming you have a recommendation for us to look at. Hold on, where to go?
Yeah, well, I had to fix it, sorry. Okay. And if we're gonna do both managers, then we just would need two different motions. We do the same motion.
So I'm asking is what is the recommendation in dollar amounts that we're recommending? So it was, I know we took 14 plus from Exponents and put it over to Manulife, but what is the recommendation from Mariner on the exact amounts? Because I don't see them here on the
Right,
recommendation.
yeah, so, and again, I think that the motion might be a little bit more involved, so I can repeat it and.
Well, I have a second motion for the money part of it.
Oh, okay.
That just basically, but again, Jeff, if you have something, that's fine.
Well, let me lay it out, Sue, and then if you just kind of lay out what our recommendation would be, and then if you need to sort of piecemeal it different, let us know. But the recommendation would be to replace Lazard emerging market debt. So in full, which is about 23.5 million. Gold, does that sound?
Yeah, 23.5.
With Wellington multi-sector. And then the second part of that would be to reallocate 25 million from Manulife to Loop Capital Core Plus.
Okay.
I think that would be two different motions.
Yes.
Right.
So I'll go ahead and make the first motion and then someone can make the second. I'd like to recommend to the full board of trustees a selection of Loop Capital as fixed income manager for the retirement system for 25 million.
Second.
Is there any questions? Any discussion? Hearing none. Sue, can I get a roll call vote?
Christina Bennett,
Yes.
Lois Cross,
Yes.
Shanice Johnson,
Yes.
Yvette Levy,
Yes.
Jennifer Orr,
That's over.
Jennifer's still there. Jennifer,
Yes.
all right,
I'm sorry, I was on mute.
that's okay. Bobby Richardson,
Yes.
Don't call me later.
Albert Sanders,
Love you too. Bye-bye.
Yes.
Doris Walker.
Yes.
All right, so we do have that motion carries.
So the second recommendation is to recommend to the full board of trustees a selection of Wellington as a fixed income manager for the retirement system for 23 million.
Second.
And I think we would want to include that they are replacing Lazard.
Sorry.
I still
So-
second.
So I will amend that to include that the funds will be transferred from the Lazard portfolio to Wellington.
Doris, you still second that?
Yes, I
Change.
still second.
Okay.
Is there discussion?
Is there any discussion? I'm sorry, is there any discussion? I was in the elevator. Any discussion?
I want to know, when would this transfer begin? When will they start?
So we have to take it to the full board at our next full board meeting. And then the transition would occur. So it's not going to happen immediately because it takes time to transfer.
And our first board meeting, full board meeting is in February, right?
Yeah, the
Correct.
end of February, I think it's February 24th.
Okay.
And then there would have to be documents, contracts with those two managers would have to be worked on, approved, and assigned before we could even do the money transfer. So
With
So-
our attorneys.
Yeah,
yes.
so Bobby,
Okay.
this isn't gonna take into effect until probably till like April,
Okay.
if we're lucky, if we're lucky.
What you mean if we lucky? What you mean?
Because of the timing of the legal documents. And then once all those are signed, then you have to go through the transition of transferring the funds. So that's why I'm saying it's not an easy process, because from February we get approval, then they have to start the contracts for legal. And then once that's signed, which is usually 30 days, then you start the transition. So that's what I'm saying, is it's just the timing.
Okay, because it could be in May. Who depends on the time transition.
Correct.
Okay.
Yes.
Okay.
So
Okay.
hearing none, can I, any other questions? Hearing none, Sue, can I get a roll call vote?
Christina Bennett,
Yes?
Louis Cross,
Yes.
Shanice Johnson,
Yes.
Yvette Levy, Yvette, are you there? All right. Jennifer Orr,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
And Yvette, are you there?
Sorry, I didn't hear my name.
I'm sorry, was that a yes?
Sorry, yes, it was.
Okay, sorry. Thank you. All right, so again, we have that motion carries as well.
Thank you, everyone. I appreciate it. Albert or Louis, I'm gonna hand this off to you guys because I am freezing where I am out right at the moment, and I can't keep my hands on this phone
Thank you
much
so
longer.
much, Chris. Where are you?
Thank you. I'm in Montreal.
Okay. Be safe and have a safe journey.
Thank you. All right, I appreciate it. All right, bye-bye.
Okay,
Bye-bye.
bye, Chris.
Okay, Al.
I think we're to Jeff and Gwilda for our splash report, correct?
Well, yeah, we have two actual items. How would you like to proceed? We've got the flash report, which will take 2 minutes because we'll do a full report in February quarterly, which will be a reiteration of this with a little bit more discussion. And then we needed to give you the results of the pacing study. So how would you all like us to proceed?
Let's do the results of the pacing study first.
Okay.
And I can, Sue, if you want to pull, I think I'm going to try. I think I can do this in 5 minutes because these are pretty straightforward. So, Sue, why don't you bring up the real estate first? Okay, and these are straightforward. This should just be one substantive page. So if you want to flip forward two, I should say. Okay. So just to sort of refresh everyone's memory how this works, because a lot of these alternative investments, the real estate, the private debt, private equity, you can't always get into them real fast and you can't get out of them real fast. So there's always the trick of how do we stay as close to our investment policy target as possible by either getting new investments or putting in redemptions or estimating when our other redemptions are coming in. And that's kind of what our research group does. They get all sorts of data and they look at all of our different managers and they estimate how much is going to be coming back from a manager, and then what that translates into and how much more we might need to fund to stay with our target. So on real estate, we have a 7% return, or sorry, a 7% target that we want to be at, and we're there. And we've had a bunch of new commitments that we made to some funds a couple of years ago, and those are still calling down capital. But more importantly, we have these UBS investments that are core that have been locked up, and they're really not paying anybody out. So those have kind of have set us in an area where we don't have a need to make any new real estate commitments. And that's where you can see, if you go to that bottom table, all the left where it says annual commitments, that's what we would estimate you have to make up until 2034. And as we're estimating today, unless UBS comes back and says, hey, we're giving you all your money back, then we really don't have any commitments, and we stay right on our 7% target for the foreseeable future. So right now we don't have any searches for real estate that we have to bring forward. So this one's pretty straightforward. Sue, do you want to bring up the private equity? Okay, and so we'll make this one it's sort of as easy, but probably a little bit more moving pieces as we go forward the next couple of years. But again, this is private equity. Remember, we did just make a couple of other commitments, and we've had some money coming back from some others. But net, we're kind of right on our 7% target. So for 2025. We haven't estimated that we need to make any commitments this year. But again, as we go through 2026, and again, we'll update this pacing study, because this is always a moving target, because we're always estimating that how much will a manager, that we just committed to, how much will they call and put to work, and then how much will they actually realize and sell and bring back. And so that's always a moving target. It is an estimate, but as of right now, we're kind of spot on. So we don't need anything next year. It's estimating that we might need to place 15 million. So nothing to do this year, again, for searches on private equity. So we've done a lot of work kind of leading up to it, and we're very much on pace here. So this is also looking good relative to our target. So no searches necessary this year for private equity. And private debt, Sue. Okay, so this one's a little bit different. We might have a little bit of work to do here. So this is remember our target for private debt is 5%. Again, recall when we did some restructuring a couple of years ago and made some recommendations. One of those was to increase that target. So again, we've been fairly active. We have a couple of new commitments that were made, but again, they've been somewhat slow and measured to call that capital. But we've made a good amount of headway from where we were from when we originally recommended this 5% target. So again, to keep us on pace, look at the left column. So in 2025, we have to commit 10 million. So we're going to work with our research group to see what funds are in market. And that's always the trick too, because sometimes there's a good fund coming to market in a year, and it's complementary to the things we have. And sometimes it's a current manager that we have that says, hey, we're going to do another fund and let's take some capital. That always kind of makes things a little bit more seamless. But in any event, this is sort of the level that we're at for 2025. So do expect that we will probably have a search before the year is out for another private debt manager. And then again, you can see 2026 would be similar. And then going forward, again, that's where assumptions get a little bit trickier and shakier, but it's sort of saying, out until 2034, if we're doing $5 million commitments a year. And again, some of those can be just add-ons to current managers that are in the program that'll get us there. But again, we're making some good headway, and you can see in that chart above, the lines are, where our actual allocations are, the red relative to the dark line, which has the triangles, and that's kind of where we want to be. And we have been making some good progress towards closing that gap. So again, the ultimate goal to kind of stay as long as to get to that 5% and kind of keep on that line as we go through time. So again, this year, what's needed to do that is a $10 million commitment. So we should have a search coming up sometime before the year is out. Questions?
So it's gonna take us 10 years to get to the our target of 5%. It's gonna take us 10 years to 2034.
No, actually, so if you look at the chart at the top right, so the red line with the squares is kind of where you're at and predicted level. And then the black line is the target. So actually it's more like 2028. So you see the two lines are sort of apart and then they come together in 2028. So
okay,
more like 3 years.
3 years. Okay. And what are those little dashes or the blue lines below going down? What do that mean?
So those are your if you were to do nothing with your existing private debt investments, not make any new investments, that's what would happen to your value. And why does that happen? It's because they realize an investment. They give you your money back. They've done what they want to do. They've made the realizations and they give you the money back. So that's always the thing we're fighting through time, is that your current managers, if they do well, they're giving you money back. But in order to keep that, to keep at a target, that's why we have to always make new investments. Your current managers want to give you money back. We have got to find ways, whether it's through your current managers, maybe they take more money from you in a new fund, or through new managers. So that's why that line goes down. And that's just if we do nothing, then you will be well below your target if we don't make further allocations in the future.
Okay, thank you, Jeff.
It's a little bit different from when we do something in a managed account with an equity manager or a mutual fund or things like that. They're a little more straightforward, that have daily liquidity and can have a lot of flexibility. Here, there's a little bit more moving pieces.
Okay, thank you.
I think I went over 5 minutes. I'm sorry.
Did pretty good though.
Questions from anyone? Okay. If not, I'll go quickly through the flash report, which we will really go deep into the quarter returns at the next meeting. So if you turn to page 1, just to kind of get an idea of what happened. Okay, you all can see here in that month column, December was a tough month. Actually, October and December, we saw negative returns. The only thing you see positive here is the Russell 1000 growth, which continues to be positive across the board. If you see there, that's actually the highest return for the 1 year number at 33.36% is the return for the Russell 1000 growth. The 3-month period here, most of that return came from November. As you can see here, everything's positive with the exception of in the equity area, except for the value index, the large cap value index, and the 2 international, both the developed represented by the EFA and the MSCI EM representing emerging markets debt. If you look down the page, that fixed income first column month, as you can see here, the numbers aren't negative for the month of December, and for the quarter, the only positive is in the corporate high yield area. So that kind of frames the discussion as to why your fund performed the way it did. Fourth quarter was it was a squirrely time. We had a lot going on. And I think the first few months of this year are going to be challenging because we're having a change in administrations. We don't know what things are going to be put in place and what the effects will be once those things are put in place. So if you could turn to page 2, this kind of shows you all where your funds are allocated. As you can see here, with the exception of core fixed income and global multi-sector, you're pretty much on target for all of the different segments of the fund. If you the value of the fund actually dropped a bit from November. As I said, November was a positive month. The fund actually dropped to 865,636,809. And for the month, the prior market value was 860. Oh, wait a minute. Am I looking at this right? Well, it's 865,636,809 is market value as of the end of December. If you turn over, Sue, to the next page, page 3, this rounds up the actual returns of the fund in the month of December, a negative 2.12 versus the policy index negative 1.81. But you can see why that is. If you go down the page, you see that we have negative numbers in the equity segments there, which is reflective of what we just saw on the prior page with respect to the markets. Actually here, Edgar Lomax, albeit negative, slightly better than the index, and the long-term return of that manager is almost in line if you look at since inception, but they have been challenged over the last year. TCW, large cap growth manager, as most growth managers have had a very difficult time keeping up with that index due to the concentration. As you can see, TCW underperformed in the month of December, a negative 1.93. A very good number for the year number, but not as strong as the Russell 1000 growth due to that index's concentration. You see here basically 31% for TCW if you round up, and the Russell 1000 growth at 33.4. If you turn over, we'll drill down a little bit capitalization wise, and you go into the small and mid cap area. In a tough market for the equity markets, you can see here, your manager's actually protected on the downside, losing 7.92%, but the index was down 8.3. Your best performing managers on a protection basis were Systematic, followed by DFA Micro Cap. Westfield did not do quite as well. And if you look at the one-year numbers, Systematic and DFA also held up very well versus their respective benchmarks over the one-year time frame. No concern with any of these managers if you look at them long-term, though. In international, Fidelity and Causeway were your two managers there, and your international value-oriented manager, Causeway, actually outperformed relatively, a negative 1% versus a negative 1.79. Fidelity, a bit more challenged, but both of those managers over the past year have exceeded their respective benchmarks. If you go to emerging markets, which is a little further down on the page, you've got DFA and Invesco having a difficult time in the month of December, both underperforming the MSCI Emerging Markets Index. Over the past year, DFA has held up much better, with having a bit more of a challenge with Invesco Emerging Markets, not only for the month, but on a long-term basis. And actually, we had them in, if you remember, a couple meetings ago to discuss. So we're looking at them closely for how they're going to improve the performance over the course of the year. The next page, Sue, Exponence, which is your global equity manager, underperformed for the quarter, negative 3.85 versus a negative 2.37. Good return for the last year, but not as strong as their benchmark with 14.7 versus 17.49. And if you look at the long-term numbers, they're struggling a bit since inception, which was 2015, 8.4 versus 9.85. And then over to the fixed income. We talked about this ad nauseum, but as you can see here, total fixed income actually protected in a tough fixed income market, negative 1.1% versus a negative 2.1% for the whole segment. Your both of your core managers actually had some weakness for the month of December. Manulife and Ernest Partners, no concerns about either one of those managers over the past 12 months. As you can see, they both exceeded the Bloomberg aggregate, both outperforming on a long-term basis. These managers have both outperformed the Bloomberg US Aggregate Index. And then we talked a lot during the presentations regarding opportunistic fixed income. The managers we're talking about replacing is Lazard EMD. And if you look at the long-term numbers for Lazard EMD, 2.2 versus 3.9. And in most periods, they just have not performed. They actually did protect this month. But if you look at that 1-year number, significantly off 2.6 versus 7.6. Neuberger protected well, not only for the quarter, but if you look at the 1-year number, their numbers are positive versus a custom benchmark, which is negative. And the TIPS, of course, is just a index fund representing TIPS. And the Luma Strategic Alpha Trust has actually done well in all time periods measured over the last year, delivering 8.5% versus a negative for the benchmark, a negative 1.34. And then the last page that we have returns for is the next page, Sue. The PIMCO all asset all off for the month. The past years they've struggled with a 5% versus 10.32. Long-term since inception, they're ahead, but this past year was very difficult for them, which has hurt their 3-year return, but their 5-year, 10-year since inception return exceed their custom benchmark. And in the hedge fund area, both Whitebox and Grosvenor have outperformed for not only for the month of December, but for the year of 2024. And the long-term numbers for both Whitebox and Grosvenor are significantly above their respective indices. And I believe that's it, because the next page is real estate. Of course, we don't have the updated numbers on that yet. We should have those hopefully by the next meeting, hopefully. Are there any questions regarding the flash report for December? And I think I took more than 5 minutes. Sorry.
Yes,
That
you
was still
did.
pretty good though.
But well, I want to say a great job. And my question is, even though some of our managers is underperforming, and I know you watching them closely,
Yes, ma'am.
when do we decide to put them on the watch list?
Your policy has specific benchmarks or returns, as well as peer group rankings that have a defined measures as to when you put them on watch, and that will be in the quarterly report. You'll have that at the next report, which will be presented at the end of mid-February. And we were working on some adjustments to the watch list because of the time frames that are currently in there are non-industry standard. So we'll see, but no, you have a definitive time period that you put managers on. You have specific measures that you have in your policy. We don't just do it willy-nilly.
Okay.
And notwithstanding, Bobby, what we're looking to revamp with those watch list criteria, the Lazard emerging market debt is probably a good example of the watch list system that we've had in place, because they have been on watch for a while on that relative performance. And so this is sort of direct result of that relative performance as to why we made that recommendation today.
Thank you, Jeff.
And I believe that's all we have for tonight, unless there's some other questions. And I thank you all for indulging us and letting us go over your time frame.
Thank you.
Well, thank you too, Gwelder.
Yeah, this is Louis, Gwelder, and Jeff. Excellent presentation, and we look forward to speaking with you all again in February.
Okay.
Fantastic. Thank you all for your extra time today.
Okay, thank you. So,
You're welcome.
Jeff, how's the weather in Chicago?
It is cold.
I
It's
make a
not-
motion to adjourn the investment committee convening for today.
It's been pretty frigid, and I think it's going the next couple days. It's going to be well below zero with the wind chill, so it's not good.
It's 1 in Milwaukee.
Yeah, and that's probably without wind chill. I bet with wind chill it's probably colder.
Yeah. Mm-hmm.
And Gwelder, you in a warm place, are you?
Well, it's all relative. We've been waking up in the 20s, and today was actually warm. It's actually got to the 50s, but we're gonna drop. We're gonna get rain, and we're gonna be in the teens on Monday morning.
I think you had some snow, didn't you, earlier?
We had snow actually. I haven't looked at it today, but I still have some ice because it turned into ice. I still have some ice in my yard.
Well, it was actually 40 something here today.
Wow, you're almost where we are.
Yeah.
Yes.
As the co-chair of the committee, I would like to make a motion. Can y'all hear me?
Dr. Albert,
We can hear you.
Dr. Albert,
Yes. No, I don't want to talk about anything else.
I'll be at Adams next week to see about my great-granddaughter.
And I won't be there. I'm so
Can't hear you.
Well, I make a motion to investment committee today.
I think we need a second on the motion.
I second that motion.
Go ahead on, sing it, Bobby.
Good night, everybody.
But we all have to say yay or nay.
Good night, everybody.
Yes.
And thank you all so much for participating.
Yay.
Yes.
Bye-bye.
Bye-bye.
Bye.
Thank you.
All right.
Have a good evening. Thank you, Gwilda.
Okay.
Take care.